All right, so we know that tax sale investing is an incredible way to build wealth, but there is a lot of confusion surrounding this business. Every time I talk about tax liens and tax deeds, I get bombarded with questions. Some are great questions. Some are based on myths that are out there. And honestly, some have never even crossed my mind until I hear them from new investors. First off, before we continue, my name is Casey Denman. I've been investing in tax liens and tax deeds for more than 22 years now, since I was age 18. And I've been training others for the past decade through my books, podcasts, videos, and the Tax Sale Academy. So today I wanted to go over some of the most commonly misunderstood parts of the tax sale business. These are questions that don't always get the attention that some people think they might deserve, especially if you're a brand new tax sale investor. You might have something that's really confusing to you, something that maybe other people don't think about. And today I wanted to try to answer a few of those questions. So whether you're just starting out or if you've been around tax sales for a while, this discussion is really going to help you navigate the process with more confidence and more understanding of this business. Now, I've got a few other episodes with some of the most common questions, so feel free to search my podcast or my YouTube channel with the word question for similar episodes. But I wanted to address some additional, more common but confusing questions that were not answered in previous videos. Let's get right to it. What happens if nobody bids on a tax deed property? So a lot of people assume that if a property goes to a tax deed auction, it is automatically going to get sold. And that is the case most of the time, but not always. In some auctions, there are properties that don't get a single bid. Now, it could be because the property just is not worth buying. It could be that there is no auction traffic. There's nobody in the audience to bid, or maybe it was just overlooked by the people that were there. Some great properties do slip through from time to time. So what happens to those properties? What happens to the properties that go to the auction and get no bids? In many states, they become over-the-counter or OTC properties, meaning that they are available for direct purchase from the county. Now, some counties will even lower the price over time to try to get rid of those properties, to get them off the books and back on to the tax rolls as tax revenue income producing properties. OTC properties provide tremendous opportunities for the investor that understands how to best utilize the system. A lot of brand new investors want to jump right into OTC investing, but I highly suggest you get some training. There's going to be a lot to that part of the business. Now, for the states that do not have OTC systems, those properties will typically end up in a land bank of sorts. And essentially, that is a collection of properties that are going to be managed by some sort of governmental agency. So they become county owned, maybe used for future public projects, maybe sold down the road as county surplus, maybe used for things like Habitat for Humanity, that type of stuff. All right, next question. Can I attend a tax sale in a different state? So if you know my backstory, I started investing in tax liens and tax deeds in my local market, my hometown market. Then I quickly realized that my income was capped if I stayed in that one market. So I expanded to another county over and another county over. Eventually, I realized my income was capped in all those counties, so I started to do what was best for me, and that was cherry pick the most profitable properties in a number of different counties and eventually a number of different states. So I ran out of properties in one state, went to the next state, and the next state, and the next state. So I was basically buying the ones that made the most sense and were the most profitable to me. So obviously, I am a huge fan of investing out of area. But every state has different rules and different processes when it comes to out-of-state bidders. For the large majority of the new states that you will register in, you simply register and bid like you would in your hometown market. The key here is to check the requirements of the auction before you show up. Now, some places will require advanced registration, maybe a week, 2 weeks in advance. So you don't want to just show up at the auction and expect a bidder number when they require you to show up and register 14 days ahead of time. Some counties will also require deposits ahead of time or affidavits that you have no taxes due in that county, or maybe even some sort of financial documents to prove that you are able to purchase properties in that area. There's all sorts of little intricacies in this business and how the counties want to interpret their specific process when it comes to selling these tax deed properties. So make sure you review those rules ahead of time. And obviously, if you invest out of state, don't just assume that process that you use in your home state is going to be the same as it is out of state, because more than likely it's going to be much different. So review the rules and review the laws in every new state that you invest in. And thankfully, of course, many properties nowadays are being sold online through virtual tax sales. It makes it a whole heck of a lot easier. All right, so what happens if the former owner is still living in the property? A lot of people get really concerned about this. You win a tax deed, it's a house, you're super excited, you drive by and you realize there's somebody living in your house. What do you do? So first off, it depends on the type of state that you are in. In a tax lien state, they have the full right to use that property until the redemption period is expired and until you take ownership of that property, whether it's through a judicial or non-judicial foreclosure of that tax lien. In a redeemable deed state, you need to check your state laws, because some states do allow the former owner, the delinquent taxpayer, to stay in that property until the redemption period expires. But in the states that do have immediate ownership, you need to really research this and see how they treat the former owner of the property. In some states, it's going to be as easy as getting a writ of possession. They'll be out within 24 hours, or you might have to actually formally evict or eject them in your state through the court system. Now, eviction laws, obviously, there's a law they have to follow, there's a process. But one of the best strategies, in my opinion, when it comes to dealing with occupants of the house is the cash for keys method. Long story short, you give them some money, they give you the keys. Peaceful transfer of money, peaceful transfer of the property. That's it. You don't have to worry about them destroying it. You don't have to worry about going to court, that kind of thing. So go the cash for keys route if you have that option. All right, next one. Can a tax deed property have environmental issues? This is actually something that's not talked about a whole lot. You might be bidding on a property that looks fantastic, you get a great deal, but what if that property used to be a gas station and it has leaking underground gas tanks that people were not aware of? Maybe it was an old paint shop and they just buried a whole bunch of stuff, or maybe it was an old dry cleaners, chemical plants, stuff like that, that can obviously have the potential to have serious environmental issues. Here's what you need to know. If the property is contaminated, you could be responsible for the cleanup cost, even though you were not the cause of the original issues. And that can run into tens or even hundreds of thousands of dollars. The worst part here is that it's not always readily obvious, and most of the time counties will not disclose this information if they even know it up front. You have to remember the county here is just trying to sell that property. They don't care what's on or anything else. They want to sell it, get it back onto the tax roll. It's up to you to perform your due diligence. So what I suggest is to check the EPA databases, state environmental records, and even Google Earth history to see what was on that property. If it looks like something was there at one time, there was industrial, there was a gas station, a plant, a factory, I would probably skip it. And if you proceed, make sure you are extremely diligent in your research and you're extremely cautious, because it might cost you quite a bit of money to clean that property up. All right, next one. Are some tax sale properties completely worthless? Absolutely. Somebody shared a clip one time with me from a guy that has a lot of tax sale investing YouTube videos and even a course. And he was saying you should buy every property possible if you can buy it for $50 or $100. Of course, buy everything. That's the absolute worst advice I have heard. And it makes it quite obvious he has not been doing this very long in the real world. A lot of tax sale investors assume that every property will have some sort of value. If it's cheap enough, you can always resell it, right? That's not always true. Some tax sale properties are so bad they literally cannot be sold, even for $1, since the carrying cost and the potential liability of owning that property shrinks your buyer pool to virtually nobody. We're talking about landlocked parcels that have zero legal access, tiny strips of land stuck between two houses, drainage ditches, retention ponds, utility instruments that you are not able to build on, air condos. These are condos that are on the second floor of a building that does not exist. These are all the types of properties that end up at tax sales because nobody wants them, because there is zero economical value to these properties. To avoid these types of properties, make sure you learn how to do your due diligence. Check the legal descriptions, check the GIS maps, check the satellite images, and perform very thorough due diligence prior to bidding. If you see something strange, like a lot that is shaped funny or a lot that is completely surrounded by private property owners, it's probably worthless and you probably need to skip it. Remember, there's lots and lots of properties to choose from, so don't get stuck on just one property. Next one. If tax sale investing is so easy, why doesn't everybody do it? It's a very fair question, and it's something I get from time to time. If it's possible to buy properties for pennies on the dollar, why isn't every single real estate investor in the world doing this? For starters, a lot of people don't know this business even exists. You are aware of it for some reason because you came across this podcast or video, and maybe you saw it somewhere eventually, maybe you searched or something like that. But I've dealt with real estate agents, people that have been in real estate full time, and they have no idea this business even exists. These are people that do real estate transactions every single day, and they have no idea that tax lien and tax deed investing even exists, much less the general public who does not deal in real estate every day. It is not something that they teach in school, and it's rarely advertised. Even among real estate investors, many people stick to the traditional stuff, the stuff that they see on TV, the bank-owned properties, the properties that were abandoned, stuff like that, because that's what they are more familiar with. Now, that's one reason. The biggest reason, tax sale investing requires effort. That's right. It requires work and it requires learning and knowledge. Unlike traditional real estate, where agents will handle a lot of the work for you, you have to do your own due diligence. You have to do your own research. You have to do your own planning and strategizing. Most people simply aren't willing to put in the time to learn the process. So if the question is, if tax sale investing is so easy, why doesn't everyone do it? Here's your 3-word answer. People are lazy. That's it. Next one. Where's the best place to invest in tax deeds and tax liens? The best place to invest depends not on me, not on other investors, but entirely on you, on your goals, your risk tolerance, your capital, your effort level. There is no single best county. There is no single best state because every single investor, their objectives, their strategies, their life is different than other investors. The doctor in California is going to invest much, much different than the college student in Florida. There's two different people, two different strategies, two different walks of life. And people need to understand this because they ask me this all the time. Where is the best market to invest? If you were me, where would you invest? Well, guess what? I'm not you. You're not me. I don't know where to invest for you. There are over 3,000 markets across the country that you can invest in that utilize the tax lien or tax deed process. Everybody is different. What you need to first determine is if you want to invest in liens, deeds, or redeemable deeds. From there, research the states that match your product type. Then, take the time to look at the individual counties. Do some research on previous auction results. See which ones are more competitive or less competitive. Figure out if you would have made money if you invested there last month, last year, 5 years ago. If it is an area where you can make money based on your product type, based on your investment objectives, then go invest in that area. Don't rely on somebody else's opinion for your hard-earned money. The best market is the one that fits your investment strategy, not somebody else's. Do your own research, make an informed decision, and stick to what aligns with your goals. Next one. What happens if somebody pays the taxes right before the auction? This can be very, very frustrating. Is when you're looking at a tax sale list, maybe a week, 2 weeks at a time, and you've got these properties circled and you're so excited about all these properties, you got your max bid amounts, you did your research, and then suddenly you get to the auction and you realize the property that you wanted was redeemed. The delinquent taxpayer came in last minute, paid those back due taxes and fees to the county, and they removed it from the tax sale auction. Super disappointing, super frustrating. I get it. Owners can often pay off their taxes up until the very end, which might mean until 5 o'clock the day before, or might even be right until that property is announced for sale at the auction. What you need to do is understand it's part of the business. Have backup properties on your list at that auction, and then have backup auctions that you can go to as well. If you're so focused on one or two tax deals, you're going at it the wrong way. You're going to go home empty-handed. You're going to go home disappointed. You should have a pipeline of potential deals always coming in. And of course, this goes back to needing to expand markets at some point, more than likely in your tax sale career. Next one, are tax sale properties ever just scams? And I'm thinking maybe somebody got a weird email or they saw something weird and they're like, is this a scam? Tax sales are not scams. In fact, it's a very specific and guaranteed process that the state laws provide for in order to produce the tax revenue to pay for the amenities that most of us use daily, like roads, schools, bridges, parks, all that kind of stuff. But scammers absolutely do exist in this space. Now, some people will sell fake tax sale lists. They'll promise guaranteed deals or partnerships where you make 100% on your money, or they claim to have exclusive access to properties that don't even exist. The safest way to invest in tax sales is to learn what you're doing, to gain the required knowledge, and then deal directly with county tax sale offices and government-run or government-contracted auctions. If somebody to sell you some sort of secret list or some sort of unreal return, all you have to do is give them your money, walk away very, very quickly. Next one. What's the biggest mistake new investors make? Not doing enough research. It's plain and simple. It's very easy to get caught up in the idea of buying cheap properties and of calculating that profit in your head. But if you don't perform the thorough due diligence, you will not make any money and you'll probably lose money. Start small, take your time, and make sure you understand what you are buying before jumping in. Learn, gain the knowledge required to perform the due diligence and to know what diligence you need to do, and then step forward. That's the biggest mistake by far, and that's the biggest leader of the reason people lose money in this business, by not doing enough research. So hopefully this has helped clear up some of the lesser known but still commonly asked questions about the tax sale business. Listen, if you enjoyed this episode, please do me a huge favor. Please take the time to leave a 5-star review. Click that thumbs up button or leave a positive feedback comment for us, because it really means a lot to us in the algorithm worlds. And as always, for the most comprehensive, in-depth training that we offer, check us out at taxsaleacademy.com. Hey, thank you so much for listening, and we'll see you next time right here on the Tax Sale Podcast. Take care and make it a successful day. See ya.